Welcome, curious minds, to the deep dive. Have you ever found yourself just, staring at the financial news, feeling completely swallowed by the endless charts, the dizzying numbers, and what often feels like a parade of conflicting expert opinions?
Oh, absolutely. It's overwhelming.
Or perhaps you've quietly harbored that secret dream of cracking the market's code, of truly understanding what makes stock prices explode upwards or tumble into a free fall, and maybe, just maybe, even predicting their next big move.
I think we've all been there, haven't we? It's this universal fascination.
Exactly. What truly drives these seemingly chaotic movements, and can we ever really predict them?
It's a compelling question, and you're absolutely right to ask. On the surface, stock prices might look like just a relentless stream of numbers moving up and down. Simple, right?
It seems that way sometimes.
But as we start to peel back the layers, you quickly realize they're far more intricate, more alive, maybe, than simple digits on a screen.
Alive? How so?
Well, they represent this dynamic, ever-changing mix of evolving expectations, asymmetric information, meaning some people know more than others, structural constraints, and these incredibly potent behavioral feedback loops.
Feedback loops.
Right.
Like people reacting to other people reacting.
Precisely. It's not just a cold, hard science of numbers. It's also a deep dive into human psychology and, maybe even a touch of unpredictable art.
Exactly. And that's precisely our mission today. We're going to try and cut through that complexity to strip back those layers of financial markets for you, our listener.
Let's do it.
We'll explore the truly unique personality of stock data itself, the often hidden forces that are actually driving prices, why the traditional tools we've relied on for decades, frequently fall short.
And they really do fall short sometimes.
No. And then, most crucially, how artificial intelligence is not just entering the game, but rapidly reshaping the very fabric of modern finance.
And maybe hinting at a surprising shift in thinking.
Yes. Moving beyond just trying to, predict the market to truly understanding it, and then, most powerfully, adapting to its ever-changing nature.
And we promise we'll try to transform what might seem like dense, intimidating financial theories into concepts that are not just easy to grasp, but hopefully full of those memorable aha moments.
Yeah, with real-world examples you can actually relate to.
Exactly. So you can perhaps even apply some of this to how you view your own investments. Let's unpack this fascinating journey.
Okay, let's unpack this. First stop, diving deep into what makes stock data so incredibly tricky. You see, financial data isn't like other data sets you might encounter.
Right, it's not like lab results.
Exactly. Not like the carefully measured results of a science experiment or the consistent output from some well-controlled factory process. Stock data is inherently messy, it's nonlinear, and it's constantly shifting beneath our feet.
And understanding that foundation is absolutely key to grasping why trying to predict the market's next move is such a monumental challenge.
So what's the first big hurdle?
The first major characteristic we need to get our heads around, and one that really trips up many models, is called non-stationarity.
Non-stationarity. Sounds technical.
It is a bit academic, but it describes a very simple yet profound idea. Financial time series are fundamentally non-stationary. What that means, in plain English,
Please.
is that their basic statistical properties, things like their average value or how much they tend to swing up and down, their volatility, are not constant over time. They don't have a stable mean, variance, or autocorrelation structure.
Okay, so if I plotted, say, the S&P 500 over the last 50 years, the average level isn't flat, and the size of the swings isn't consistent either.
Not at all. It's like trying to hit a moving target, but not just any moving target.
Right, you said it keeps changing.
Yeah.
Its speed, its direction.
Precisely. And even the very rules of its movement. What worked to hit it yesterday might completely fail today. Prices often follow what's called a unit root process.
More jargon.
Yeah, sorry. Simpler terms. It means they're very close to a random walk. Think of it like today's price is basically yesterday's price, plus some random step up or down that makes it inherently unpredictable in a traditional sense.
Okay, random walk. Got it.
And even stock returns, which are often thought to be more stable, more stationary, even they show what's called drift instability, time-varying autocorrelation, and distributional shifts.
Wow, okay. So even the nature of the randomness itself keeps changing.
Exactly. The implication for any model trying to predict these movements is huge. It means your predictive models must be regime aware.
Regime aware. meaning they need to know what kind of market mood we're in.
That's a great way to put it. They need to know what kind of market environment they're operating in. What works perfectly in a roaring bull market might completely implode during a sudden bear market or a crisis.
Like using summer tires in a blizzard.
Exactly. The rules, the environment have fundamentally changed.
Okay, so non-stationarity is hurdle number one. The ground is always shifting. What's next?
Next up is volatility clustering. If non-stationarity is like a target changing speed and direction, volatility clustering is like that target sometimes throwing itself into a sudden flurry of erratic motion, then calming down, then flurrying again, but in bursts that stick around for a bit.
So volatility isn't just random, it clumps together.
Precisely. Quiet periods tend to be followed by quiet periods, and periods of high volatility tend to follow other periods of high volatility. The technical term for it is heteroskedasticity. Skedasticity.
Yeah, it just means different variance.
Yeah.
The amount of price swing isn't uniform over time.
It's like the market has distinct moods, right? Like calm seas suddenly turning into a raging storm that persists for a while, days, weeks maybe, before calming down again.
That's a perfect analogy. It doesn't just storm for an hour and vanish. It lingers. It has a memory of its own intensity.
And this is something people have noticed for a while. Oh yes, this mood behavior is incredibly well documented. It's so prevalent that sophisticated statistical models like RShoot and Garsheech were specifically developed just to capture and predict this clustering behavior.
RSeed and Garsheech, okay.
And more recently, even deep learning models like LSTM-based volatility forecasters are proving quite good at recognizing these patterns.
Any examples jump out?
Think back to the COVID-19 shock in March 2020. Volatility didn't just spike for a single day. It surged and persisted across virtually all asset classes for weeks, even months.
I remember that feeling. Everything felt unstable.
Exactly. And models that were explicitly designed to account for this volatility clustering, like JAR, RShoot, and LSTM, were far better at tracking that prolonged period of market turbulence than simpler models that just assumed constant volatility.
So the implication here for any model, or any investor really, is clear. Accuracy significantly improves when you don't just guess at volatility, but actually account for this volatility state as a kind of hidden variable.
Absolutely. If you know the market is in a stormy phase, how does that fundamentally change how you or a model approaches predictions and, maybe even more importantly, risk?
Right. What's the practical shift in strategy when that hidden variable becomes clear?
It's a profound shift. When you understand the volatility state, your risk parameters instantly change.
Yeah.
In a high volatility regime, models might say reduce their position sizes to manage larger swings or prioritize capital preservation, maybe even shift to strategies that explicitly profit from volatility itself.
And in calm periods.
They might take larger positions or favor strategies that thrive on stable trends. It's all about being responsive, not just predictive.
Got it. Responsive. Okay, what's the third tricky characteristic?
Our third crucial characteristic is what we call fat tails and skewness. This is where stock returns truly defy traditional statistical assumptions, the ones that underpin a lot of classical finance.
Like the bell curve.
Exactly. The neat symmetrical bell curve, the Gaussian or normal distribution. Most natural phenomena, like human heights or coin flips, tend to follow that curve. Most results cluster around the average. Extreme results are very rare.
But stock returns, not so much.
Not so much. They have what we call fat tails and leptokurtosis.
Lepto what?
Leptokurtosis, fancy word for fat tails. It means those super rare extreme events, like a stock suddenly crashing 20% in a day, or maybe skyrocketing 15%, happen much, much more often than that neat bell curve would ever predict.
Like rolling a six-sided die, but every now and then you suddenly roll a 100 or a negative 50.
That's a great way to think about it. Those are the tail risks, the events way out on the far ends of the distribution that defy conventional expectations and can blindside traditional models built on nice, normal assumptions.
And skewness, what's that add to the mix?
Skewness means the distribution isn't symmetrical. It often leans more one way than the other. For example, stock returns are often negatively skewed, meaning you might see more frequent small gains, but also a higher chance of large sudden losses, which is exactly what investors fear most, right? That big drop.
Definitely.
And this leptokurtosis, combined with skewness, is particularly pronounced during market stress. This inherent characteristic often leads to a significant underestimation of risk by traditional models because they assume a world that's far more predictable and contained than reality.
This sounds like it could explain why so many supposedly robust models crumbled during, say, the 2008 financial crisis or the flash crash of 2010. You mentioned Black Monday in '87 and the flash crash as examples where returns deviated by more than 6 standard deviations. How fundamentally impossible are events like that under the old bell curve assumptions? Can you make us feel the shock of that deviation?
Okay, well, if you assume a perfectly normal distribution, a bell curve, an event 6 standard deviations away is statistically so improbable it should happen, on average, less than once every billion years.
Billion. With a B.
With a B. So for it to occur multiple times in just a few decades in financial markets, it's a stark, almost violent rejection of those tidy assumptions. It reveals that the ground beneath our feet is far more prone to these sudden, massive seismic shifts than we might comfortably believe.
Wow. So models need to be built differently.
Absolutely. The implication for models is that they need to be robust to nonlinear outliers. They can't just assume a smooth bell curve. They need to incorporate frameworks that account for things like jump diffusion, sudden discontinuous price changes, or stochastic volatility, where volatility itself is dynamic and random rather than fixed.
Okay, jumps and random volatility. Got it. Moving on. Number 4.
Our fourth characteristic deals with autocorrelation and memory effects. Now, standard financial theory, like the efficient market hypothesis, often suggests prices follow a random walk, meaning past price movements tell you nothing about the future. Pure randomness.
Right, that's the classic idea.
But in reality, while linear autocorrelation, a direct, simple relationship between past and future prices, might be low on average, subtle patterns, higher-order dependencies, do seem to exist over certain time frames.
Like what kind of patterns?
We observe phenomena like momentum, where stocks that have performed well over specific horizons, say the last 1 to 12 months, tend to continue performing well for a while longer.
Buy winners, basically.
Kind of. And conversely, mean reversion can occur, where prices that have moved to extreme highs or lows tend to snap back towards an average over longer periods.
Buy losers or sell things that have gone up too much.
In essence. But here's the truly dizzying part, the catch.
There's always a catch.
It's like the market is playing a never-ending game of whack-a-mole with its own rules. The trick is that these patterns decay quickly once recognized. The moment a pattern becomes widely known and traded upon, its effectiveness starts to erode.
That makes perfect sense. If everyone jumped on the momentum strategy because it was working, the edge would just disappear quickly as too many people chased the same signal, pushing prices up too fast.
Exactly. But for a while, strategies based on stocks with strong 6 to 12-month performance continuing to outperform have been the very basis of many successful quant momentum strategies.
So for a model, this isn't just about finding a pattern. It's about realizing that the pattern itself is alive and constantly trying to escape recognition, right? It's not static.
Absolutely. This forces predictive models into a constant state of relearning, trying to catch these dynamic shifts before they vanish. It means what was a brilliant strategy last quarter might be totally obsolete next week or even tomorrow.
So the implication is clear. Models must continuously relearn or adapt. They can't just be trained once and left alone.
Not if they want to survive long term.
Okay, next characteristic. This is fascinating stuff.
Next up, we have microstructure noise and directional ambiguity. This gets into the nitty-gritty of how trading actually happens, the very plumbing of the market.
The plumbing, like bids and asks.
Exactly. When you look at standard market data like open, high, low, close, and volume, what they call OHLCV, it doesn't actually tell us the whole story. For instance, a big jump in trading volume might look like everyone is rushing to buy a stock.
Yeah, big volume, price up, must be buying, right?
Not necessarily. The reality can be much more nuanced, much more ambiguous. That volume spike could mean aggressive buying, yes, but it could equally mean aggressive selling, or maybe just a lot of passive orders meeting in the middle.
So the standard data lacks clarity.
Precisely. Most market data, OHLCV, lacks clarity about directionality of flow. Key information like the bid-ask spread, the difference between the highest buy price and the lowest sell price, or the order book depth, how many shares are available at various price levels, and buy-sell imbalance, whether buyers or sellers are being more aggressive, are often hidden from standard data sets. You're seeing the total number of trades, but not who initiated them or how urgent they were.
So a volume surge post-earnings doesn't actually reveal if the flow is truly buyer-driven or seller-driven without digging deeper. It's like trying to understand a conversation by only hearing the overall volume, not the actual words or intent.
That's a perfect analogy. The implication is that enriching data sets with microstructure features is crucial. Using things like level 2 data, which shows the order book, or trade classification algorithms can reveal the true directional intent behind price movements.
And that's a powerful signal simpler models miss.
It can be incredibly powerful, especially for shorter-term predictions. It tells you whether the market is truly pushing higher with conviction or just seeing temporary oscillations based on who is hitting the bid versus lifting the offer.
Okay, fascinating.
Yeah.
And the last characteristic.
Finally, and this is a really crucial one, often overlooked, behavioral and feedback-driven dynamics. This reminds us that financial markets aren't just cold, logical physical systems, responding purely to economic inputs like interest rates or earnings.
Right, people are involved. Irrational people sometimes.
Exactly. They're profoundly driven by human behavior, emotions, and biases. People aren't just reacting to data. They're anticipating what other people will do, which can lead to powerful, self-reinforcing, or reflexive patterns.
Reflexive, meaning the act of participating changes the outcome.
Yes, precisely. Participants observe, anticipate, and act based on expectations of others' expectations. It gets very meta.
My head hurts already.
It creates phenomena like herding, where everyone rushes to do the same thing, often regardless of their own analysis and sentiment cycles that can literally become self-fulfilling prophecies, driving prices up or down in a spiral.
So fear breeds fear, and greed breeds greed.
In a way, yes. Even seemingly neutral news can trigger these feedback loops simply because of how people are already positioned or feeling, leading to a cascade of reactions.
The examples you gave are great illustrations. NVIDIA's rally in 2023. It wasn't just about earnings.
Not just earnings, those were certainly strong. It was also profoundly about the market's belief in AI dominance, this powerful, overarching narrative that became a self-reinforcing loop. Believing in AI dominance led to capital inflow, which pushed prices up, which reinforced the belief.
And drew in more capital.
Got it. Similarly, the wild ride of meme stocks in 2021, like GameStop or AMC, showed how incredibly reflexive retail behavior can temporarily dominate fundamentals. People weren't necessarily buying because the company's value changed overnight.
They were buying because other people were buying, and it became a movement.
Exactly, a social momentum that became a market force in itself. What's fascinating here is that market data is partly endogenous. It's not just reflecting reality. It's actively shaped by participants' reactions to reality and their reactions to each other's reactions.
So models need to consider this, how the model itself might affect the market.
Ideally, yes. They need to consider model reflexivity and crowd behavior. It's a complex, ever-shifting dance between objective data and subjective human interpretation, where the act of observation, or trading itself, can alter the thing being observed.
Okay, so stock data is a truly wild beast, non-stationary, prone to volatility, clustering, and fat tails, with hidden memory effects, noisy microstructure, and this powerful, often unpredictable human behavioral component.
Wow. It's a lot to wrap your head around.
It really is.
But now that we understand the inherent challenges of the data itself, what are the actual engines driving these movements? What are the concrete forces at play that truly push and pull stock prices?
That's the crucial next step. Beyond the inherent weirdness of the data, there are concrete, identifiable factors actively pushing and pulling prices. We can group them, starting with the bedrock, the most conventional, fundamental drivers.
Right. The stuff you learn in Finance 101, all about the company's core health, its underlying business. Exactly. At their heart, stock prices are often seen as the present value of expected future cash flows. So key fundamental variables are things like earnings and EPS growth, often the primary input into valuation models.
How much money they're making.
Right. Then revenue trends, a leading indicator of growth potential. Profit margins and return on equity, crucial measures of how efficiently they run the business. Dividend yield and payout ratios, a direct contributor to total return for some investors. And leverage and debt ratios, which impact risk and how much people are willing to pay for those earnings.
So pretty straightforward. If a company reports a positive earnings surprise, better than expected, its stock typically goes up because future expectations get revised upward.
Generally, yes, that's the textbook case. But then we quickly move into the broader landscape with macroeconomic drivers, the big picture stuff.
Like interest rates, inflation, GDP growth, things that affect everyone.
Precisely. These broader forces affect everything from the required return investors' demand to capital flows across entire sectors. Think about interest rates, the Fed funds rate, the 10-year Treasury yield. They profoundly affect the discount rate used to value future cash flows. Higher rates generally mean lower stock valuations.
Because future money is worth less today.
Exactly. They also influence the cost of capital for companies. Inflation expectations impact real returns and monetary policy. GDP growth correlates broadly with sales growth. Employment and labor costs affect business costs and consumer demand, and exchange rates are key for multinationals.
So a classic example is rising interest rates typically depress equity valuations, especially for growth stocks whose value is tied to far-off future earnings.
That's a very common dynamic we see playing out.
Fascinating how a small change by a central bank can ripple through everything. Now let's talk about something maybe less obvious. Market microstructure factors, those hidden trading mechanics again.
Yes, these are the forces revealed by how trades actually happen, showing short-term pressures. Variables like the bid-ask spread. Tight spreads usually mean efficiency and liquidity. Order book depth tells us the immediate supply and demand near the current price.
How many shares are waiting to trade?
Right. Trade imbalance reveals if buyers or sellers are being more aggressive right now. Short interest can signal potential for a short squeeze or just strong bearish conviction. And volume shocks can indicate big institutional interest or news hitting the tape.
So you gave the example, a large buy imbalance near the ask in a thinly traded name. Lots of aggressive buyers in a stock that doesn't trade much can cause abrupt price jumps without any fundamental change.
Yeah.
That's pure mechanics.
Absolutely. It's the immediate forces of supply and demand creating price moves independent of the company's long-term prospects. It's all about the flow.
Okay, flow. Next up, derivatives and options market signals. You're saying the options market acts like a crystal ball for market expectations.
In a way, yes. It's reading the tea leaves of expected volatility and sentiment. Implied volatility, derived from options prices, is a direct forward-looking risk or uncertainty estimate. It tells you how much the market thinks the stock will move.
So high IV means the market expects big swings.
Correct. The put-call ratio, comparing bets on a fall versus bets on a rise, is often used as a sentiment gauge. High put volume might mean bearish sentiment. And then there's gamma exposure, GEX. This one's a bit more technical.
Yeah, break that down. How does dealer hedging actually affect prices?
Okay, so when option dealers sell options to investors, they need to hedge their own risk. If they sell lots of call options, they might buy the underlying stock to stay neutral. As the stock price moves closer to a major option strike price, their hedging needs change rapidly. They might be forced to buy more stock if the price rises towards the strike or sell stock if it falls away. This concentrated buying or selling by dealers can actually pin a stock near that strike price, acting like gravity, especially around options expiry.
Well, like a magnet.
Or, if the price moves rapidly through a strike zone, their frantic rehedging can act like rocket fuel, accelerating price moves as they chase the market. It's a powerful hidden force. Open interest also matters, showing where liquidity and positioning are clustered.
So a stock might get stuck near a price with high open interest just because of this dealer hedging effect.
It's a well-observed phenomenon, especially around monthly options expiration.
That's a powerful and often overlooked force. But speaking of sentiment, let's get back to the human element with behavioral and sentiment drivers, the emotional side.
This is where the market truly shows its human, sometimes irrational side. Retail and institutional sentiment can lead to herding or momentum buying selling, just following the crowd. News flow and social media can trigger sudden changes in narrative.
Yeah, a tweet can move markets now.
Absolutely. Analyst revisions and upgrades can re-anchor expectations. Broader fear-greed cycles cause volatility asymmetry. Panic selling is often faster than euphoric buying. And of course, FOMO, fear of missing out, and loss aversion lead to non-linear responses, people reacting differently to potential gains versus potential losses.
And we saw this play out dramatically with the meme stocks in 2021, GameStop, AMC. Those weren't driven by fundamentals. They demonstrated how reflexive retail behavior can temporarily dominate fundamentals. Pure crowd psychology.
A textbook example. The narrative became the driver, at least for a time.
Okay, almost there. Penultimate category.
Structural and regime-based drivers. These are the big, slow-moving tectonic plates shifting the entire market backdrop. Not about daily news, but long-term changes.
Like capital shifting between industries.
Exactly. Sector rotation capital flowing from growth to value, or tech to energy, for instance. Technology disruptions like AI or cloud that reframe entire industry value chains. Regulatory cycles impacting whole sectors. Geopolitical events acting as catalysts for volatility and realignment of capital flows. And market leadership shifts that break down historical patterns.
Like the rise of AI recently.
Perfect example. The rise of AI in 2023-2024 completely reshaped tech stock leadership, rapidly moving capital into semiconductors and large language model infrastructure providers, away from previously dominant segments.
Okay, now here's a truly surprising one you mentioned. Price movement and market reactions themselves. We usually think price is the result, but you're saying price movement itself becomes a driver, a feedback loop.
This is a critical nuance, and it speaks directly to that reflexive nature we talked about. While theory often separates price as an outcome, in practice, it's a powerful input feeding back into the system.
How does that work?
First, investor anchoring. If a stock has already surged 50%, even great news might be ignored or discounted because people think it's already priced in. The prior price action creates a psychological anchor.
So the run-up itself changes how people view new information.
Precisely. Second, many systematic portfolio allocation models literally use past returns as signals. Momentum and trend-following strategies are built on this premise. Price action directly dictates their buying or selling.
Okay, that makes sense for quants.
Third, institutional flow is incredibly price reactive. Big funds often react automatically to breakouts above key levels or oversold thresholds. Price action itself can crowd out fundamentals, especially in systematic strategies.
And lastly,
Even if a company is great, volatility changes weighting. High volatility, triggered by big price swings, can automatically force risk management systems to reduce position sizes. Investors might hesitate or cut back just because of the choppiness, regardless of the underlying business quality.
so price isn't just a speedometer. It's also a steering wheel. Its movement generates feedback that influences behavior, allocation, and future prices.
Exactly. It's a core dynamic driver that sophisticated models absolutely must consider today.
Wow. Okay, now that we understand the wild, messy, almost living nature of stock data and the multifaceted drivers pushing and pulling prices, let's turn to the tools we've historically used to try and make sense of it all. For decades, brilliant minds tried to tame this beast, build models to predict its next move.
Right, the history of financial modeling.
But as we'll see, the complexity often exposes fundamental flaws in these traditional approaches. What if the very nature of this chaos meant our trusted tools were perhaps always destined to fall short? Let's explore why even the smartest traditional models often hit a wall.
Indeed. It's a journey from simplicity to, well, realizing reality is much messier. We'll start with the classical models, cornerstones of finance, but often showing their age.
First one that comes to mind for many is the capital asset pricing model, CAPM, taught in every finance class.
It is, and it remains foundational for some things. CAPM's premise is simple. Your expected return depends mainly on its beta, how much it moves with the overall market. High beta, higher expected return, supposedly.
Strength is simplicity.
Simplicity, intuition, and it forms the basis for calculating the cost of capital in corporate finance. Still used there.
But, the big but, if it was that simple.
Very big but. Empirically, beta explains little variance in cross-sectional returns. It just doesn't do a great job predicting which stocks will actually outperform. Critically, it ignores factors like size, value, and momentum, which research shows are important.
So, good theory, less useful for actual prediction.
Pretty much. A starting point, but reality quickly complicates it.
Then there's the Black-Scholes-Merton model, BSM, revolutionized options pricing, Nobel Prize stuff.
Absolutely foundational. BSM's premise is elegant. Option prices assume the underlying stock follows a geometric Brownian motion, a random walk where returns are normally distributed and volatility is constant. It allowed options markets to explode.
But wait, didn't we just spend ages talking about how stock returns aren't normally distributed, fat tails, volatility clustering?
Exactly, and those are its biggest weaknesses. BSM assumes constant volatility and a log-normal distribution, assumptions violated in practice by the real market. This leads to things like the volatility smile, where options prices imply different volatilities, contradicting the model.
The market smiling at the model's simplicity.
You could say that. To fix this, modern alternatives like the Heston model use stochastic or random volatility, and Merton's jump-to-fusion model accounts for those sudden price jumps, the fat tails.
So classical models were built for an idealized market that doesn't really exist. What about models that try to capture patterns over time? Econometric and time series models.
These try to identify statistical patterns. Take ARIMA, a staple, good at basic trends and seasonality, but its weakness. Poor at handling sudden shocks or the nonlinearities in finance. Struggles with fat tails and regime shifts.
And Arch-GRHH. We mentioned them for volatility clustering.
Yes. Specifically designed to model and track that volatility clustering. Excellent for risk estimation, like calculating value at risk, VaR, tells you how much things might swing.
But not which way.
Exactly. Rarely useful for return prediction. They tell you the size of the waves, not the direction of the tide. There's also Markov regime switching models, which identify different market regimes, high versus low vol, bull versus bear.
That sounds adaptive.
Sort of, but they still require guessing what the regimes are and often rely on linear assumptions within each regime, still limited when facing truly novel conditions.
Okay, good for risk, not predicting returns. This leads us to quantitative factor models, explaining returns based on broad factors, beyond just market beta.
This is where Fama and French come in, with their 3-factor, then 5-factor models, and Carhart adding momentum. They propose returns are explained by factors like size, value, profitability, investment, empirically grounded, widely used for understanding sources of returns.
Understanding why you made or lost money. But the criticisms for prediction.
Pretty significant. A major issue is lack of stability. Factor premiums are not stable over time. The value factor, for instance, struggled massively after 2008. Momentum can fail spectacularly during reversals and crisis periods.
So the factors themselves aren't reliable predictors.
Not consistently. There's also factor redundancy. Some might just measure the same underlying thing. More critically, many factors found in research show weak out-of-sample performance. They fail when tested on new data.
Meaning they might have just been found by chance in the historical data snooping or by hacking.
Precisely. Look hard enough, you'll find a correlation. And maybe most importantly, these models are inherently linear and static. They assume simple relationships and do not adapt to regime changes or nonlinearity, which we know defines financial data.
Right. Finally, the technical and rule-based systems. Moving averages, RSI, MACD, what most people picture as active trading.
Common techniques like moving averages, MA, RSI, MACD, Bollinger Bands. Strengths are simplicity, easy to understand, widely adopted, especially for trend following.
So why do they often fall short if they're so popular?
They lack statistical rigor, often lagging indicators, signaling a change after it's happened, missing turning points. And most critically, performance deteriorates as strategies become crowded.
Like the Golden Cross, 50-day moving average crossing the 200-day.
Classic example. Popular, but its effectiveness has declined due to overuse and latency. If everyone uses the same simple rule, the edge disappears, arbitraged away.
So traditional models, however clever, consistently hit walls against the dynamic, messy reality of markets. Sounds like a problem waiting for a new solution. This brings us to the dazzling promise of artificial intelligence. How is AI trying to solve these deep, persistent problems?
The promise of AI in finance is incredibly seductive, right? Uncovering hidden patterns, processing massive data streams, maybe outperforming traditional models. But to really get it, we need a quick detour into AI history itself. The rise of deep learning, exemplified by something called AlexNet.
AlexNet. Heard that name. Especially regarding breakthroughs. What was its big deal?
Developed in 2012 by Alex Krzyzewski, Ilya Sutskever, and Jeff Hinton. At its core, it was a deep convolutional neural network, a CNN, designed for image classification. Think of it telling a cat from a dog from a car in pictures.
Image classification. Okay, connect the dots for me. Cats and dogs to stocks. Feels like a leap.
It is, but the connection is profound. AlexNet was a watershed moment. It was the first widely recognized application of deep convolutional networks in large-scale visual recognition that really showed their power. It won the ImageNet competition, the Olympics of computer vision, by a massive margin, error rate of 15.3% versus the next best at 26.2%. A huge leap.
What enabled that leap? What made it so special?
Several things converged. The depth of the model was crucial. 8 layers learning increasingly abstract features. This depth was feasible because of powerful graphics processing units, GPUs. They famously used 2 NVIDIA GTX 580 GPUs gaming hardware repurposed for AI.
So processing power was key.
Huge. Plus, clutter techniques. The ReLU activation function helped train deeper networks, dropout regularization, prevented just memorizing data, and data augmentation made it more robust.
So bigger network, smarter training, better hardware, perfect storm.
Exactly. Fei-Fei Li called it the moment 3 fundamental elements of modern AI converged. Large datasets, GPU computing, and improved training methods. It was an unequivocal turning point. It showed deep learning could learn complex features directly from raw data, something humans used to do manually. Machines could learn to see.
Okay, now the finance connection.
Yeah.
Still picturing cats.
Just as AlexNet found hidden patterns in images too complex for older methods, AI in finance aims to uncover nonlinear, high-dimensional relationships in financial data. Think about order book flows, buy-sell orders at different prices. You can visualize that. Treat it almost like an image representing market pressure.
Ah, okay. Like a heat map of buying and selling.
Sort of, yes. Or financial time series with all their non-stationarity, fat tails, complex dependencies. Exactly the kind of intricate relationships deep learning is designed to find. AlexNet showed what happens when you give a powerful model enough data and compute to learn its own features. That capability translates directly to finance.
That's a fantastic connection. So how are these powerful AI techniques actually being applied in quant finance today, beyond just looking at order books like images?
AI offers a powerful suite of new tools for that messy data. It's being used across various domains.
Let's run through some. First, alpha signal generation, the holy grail, finding predictive signals.
The holy grail indeed. Here, supervised machine learning like XGBoost or SVMs identifies signals from structured numbers and unstructured text, like news. Then there's time series forecasting using LSTMs, GRUs, transformers models good at learning nonlinear dependencies and memory in sequential price data.
And that real-time trading data, market microstructure.
For that, convolutional neural networks, CNNs, like AlexNet plus reinforcement learning, RL, and graph neural nets model intricate order book dynamics and trade flows. Imagine a CNN analyzing order book snapshots like images to spot patterns humans miss.
That's a great analogy. What about market mood, investor psychology?
Sentiment analysis. Using natural language processing, NLP models like Finbert or GPT-based models to extract insights from earnings calls, news, social media chatter, mountains of text.
Turning words into signals.
Exactly. Then portfolio optimization using reinforcement learning RL to discover adaptive allocation policies through trial and error in simulations. And risk detection using anomaly detection or genes to spot rare stress conditions and structural shifts traditional models might miss, finding the odd one out that signals trouble.
That's an impressive range. What are the key strengths AI brings that traditional models lacked?
Primarily nonlinear pattern recognition, finding complex relationships linear models can't. Also, multimodal data fusion, combining numbers, text, prices into one analysis. Its speed and automation allow rapid recalibration. And theoretically, some offer adaptive learning, responding to regime shifts.
So many hedge funds are using AI to refine entry-exit timing, filter noise, score opportunities with dozens of interacting variables. Sounds like the magic bullet.
Ah, not so fast. Despite the excitement, AI models face significant hurdles in real-world finance. They often fail precisely when conditions change most dramatically. This brings us to the hard truths, limitations and failures of AI in finance. The market is uniquely challenging.
What key challenges make these powerful models stumble? Non-stationarity again. How does that specifically hit AI?
It's huge. Markets evolve, historical data may no longer be relevant. AI, especially deep learning, excels at learning historical patterns. But if the market fundamentally changes its rules, memorizing the past isn't enough. They often don't adapt well without sophisticated design for that specific purpose.
And overfitting to noise? Getting too good at the wrong thing?
Exactly. The market has a low signal-to-noise ratio, lots of randomness. High-capacity AI models are so good at finding patterns they can actually memorize noise, treating random fluctuations as real signals. Looks great in back tests, fails miserably live because noise doesn't repeat predictably.
And the dreaded black box problem. Can't see inside.
The lack of interpretability. Many advanced AI models are so complex, it's nearly impossible to know why they make a decision. Big problem for risk management and regulation, which demand transparency. Then there's reflexivity and crowding. If too many AIs use similar signals, they can destabilize prices via feedback loops, all reacting to each other.
A herd of intelligent algorithms stampeding.
Exactly. And finally, data biases. Things like survivorship bias, only seeing successful companies, or selection bias can make models unreliable. If training data isn't representative, the model will be brittle.
You mentioned some stark case studies of failures, even from top quant funds. Renaissance Technologies public funds like RIEF struggled, unlike their famous Medallion Fund.
Indeed. Medallion is legendary, but the public funds lost around 20% in 2020 when the S&P was up 18%. Why? Their models failed during pandemic-driven volatility due to reliance on statistical relationships that broke down. lesson. When statistical edges vanish and positions become crowded, even AI-enhanced models fail.
2 Sigma also underperformed around that time.
Yes, attributed to regime shifts, like the value factor breakdown and factor crowding, shows even advanced AI struggles if the market structure shifts or everyone chases the same signals.
And Quantopian, the platform for crowdsourced AI strategies.
Great idea, democratizing quant finance. But the reality, most algorithms performed well in backtests but failed in live trading due to slippage, overfitting, and real-world frictions. Brutal lesson. Backtested tradability. Real-world issues overwhelm naive models.
It sounds like 2020, the COVID crisis, was a real breaking point, like the market rewriting its laws just to mess with the models.
It absolutely was a regime rupture, a sudden breakdown of statistical norms, momentum reversed, volatility exploded, correlations broke, extreme crowding risk as similar models unwound simultaneously, massive execution stress with liquidity gaps, a perfect storm exposing brittleness. Big lesson. AI can't save a strategy that's blind to structural market changes. Models need to observe, adapt, and recalibrate constantly.
So if traditional models and even first-gen AI often struggle with the market's dynamic nature, what's the path forward? You mentioned shifting from static prediction to adaptive understanding, the essence of AlphaQ intelligence.
That's right. The core idea behind adaptive modeling is that models aren't fixed. Instead, they constantly monitor regime changes, actively looking for shifts in market mood or rules. They dynamically update or reweight signal models based on current performance. And they use real-time price behavior, sentiment, flow data to infer market intent or structural shifts.
I like the metaphor of a skilled sailor, not just predicting the weather once, but constantly adjusting sails based on real-time wind, currents, storms. Constant responsiveness.
It's precisely that. Key goal. Dynamically respond to structural changes, rather than assuming signals are stable forever. Models evolve, learning not just from data, but also from market feedback loops and breakdowns in prior assumptions. It's a shift from what will happen to what kind of market is this right now, and how should I respond?
So what are the core components of such an adaptive framework? How do you build a system that can constantly adjust?
First, market regime detection. Using tools like clustering or volatility analysis to identify if the market is trending, mean reverting, or in high volatility. Understanding the environment. Second, signal stability testing. Continuously checking if a predictive signal is still working right now.
Like an internal auditor for your strategies. Don't keep using it if it's broken.
Exactly. Third, dynamic model selection. Having a repertoire of models and actively swapping them in or out based on performance or regime. Market shifts from trend to mean reversion. Deploy the mean reversion model. Fourth, feedback integration. Adjusting based on actual trading outcomes, realized performance, slippage, and how the market reacted. A continuous learning loop. And finally, probabilistic forecasting, providing confidence intervals or scenario modeling, acknowledging uncertainty.
So how does this adaptive modeling fundamentally differ from traditional and static AI prediction? Seems like more than just an upgrade.
The differences are stark. Take the assumption of stationarity. Traditional models assume it. Static AI struggles when it breaks. Adaptive models explicitly reject it and model regimes directly.
Built from the ground up expecting change.
Yes. For signal nature, traditional are linear, static AI are nonlinear. Adaptive focus on conditional evolving signal reliability. Is this signal reliable now? For recalibration, traditional is periodic batch, static AI often similar. Adaptive aims for real-time adjustment, selective model switching, like tuning your guitar while playing.
Huge difference. Always learning.
Precisely. And their response to regime shifts? Traditional fail. Static AI is inflexible unless retrained. Adaptive are designed to detect and adapt dynamically, leading to the core takeaway. In dynamic markets, adaptivity beats accuracy. A less accurate but flexible model can outperform a precise but brittle one when conditions change. Robustness over pinpoint accuracy.
Can you give concrete examples of adaptive strategies in practice?
Sure. Volatility regime adaptive models are common, changing strategy based on high or low volume, used in macro funds. Rolling ensemble models, continuously picking the best performing signals from a collection, discarding underperformers.
Survival of the fittest signals.
Exactly. Bayesian networks update signal reliability based on recent results, giving probabilistic forecasts with confidence levels. And structural break detectors tools alerting traders when the market structure itself fundamentally changes, like a trend collapsing. Seismic sensors for market shifts.
Sounds incredibly powerful. Almost like a living system. But the challenges in building these, nothing's a magic bullet, right?
Significant challenges. Risk of overreaction, adapting too fast, chasing noise, huge computation and latency needs for real-time tracking, complex model governance, robust monitoring, rollback systems, and often an interpretability trade-off. More adaptive can mean less explainable, needing extra transparency tools.
So the insight is, future isn't perfect foresight, but resilient design and adaptive understanding. From what happens next to what market is this now and how should we respond?
Precisely. Building systems prepared for the unknown, not just optimized for a known past.
We've covered so much ground. The tricky nature of data, drivers, limits of old models, promises, and pitfalls of AI, but the ultimate evolution of AlphaQ intelligence. It isn't AI replacing humans, right? It's a partnership, symbiotic modeling.
This is truly the most promising direction, where AlphaQ intelligence really shines. Purely algorithmic models, however advanced, repeatedly failed during major shifts. They struggle when behavior escapes statistical norms, brittle machines. Yet, human investors, while intuitive and adaptable, are biased, have limited memory, struggle with high dimensions, get fatigued.
So neither works perfectly alone. The aha moment is a hybrid approach where AI proposes hypotheses and humans guide constraints and interpretation yields a far more robust ecosystem than either acting alone. This partnership is AlphaQ intelligence.
Absolutely. Think of a continuous feedback loop. Human expertise, AI models, and the real market. Top, human domain expertise loop providing hypotheses, themes, constraints, regime interpretation, the strategic direction, the why.
Bottom, market environment layer, the real-time data stream. Price, volume, flow, fundamentals, news, sentiment, raw material.
Middle, MLAI modeling layer processing data, doing pattern detection, risk mapping, adaptive allocation, the heavy lifting, and crucial for feedback, the signal episode monitor, a watchdog detecting alpha decay, signals failing, sending regime change alerts, feeding feedback to AI and humans.
This closed loop sounds incredibly powerful. Key benefits of this symbiosis.
Much greater interpretability in decision-making. Machine insight support human understanding, not a black box. Feedback-driven learning humans can reinforce or override AI based on outcomes and qualitative insights, and collaborative strategy evolution. The system gets smarter through continuous human-AI interaction, a truly living system.
Let's walk through an example. Symbiotic modeling loop during a volatility regime shift. Say, a long volatility AI strategy starts losing money as market calms down after a crisis.
Okay. A traditional static AI might keep losing until a scheduled, delayed retraining weeks or months later, blind to the shift.
But with the symbiotic framework, AlphaQ intelligence in action.
Exactly. First, human insight. An experienced human tags a potential regime transition based on macro signals or news the AI might miss. An early warning.
Human triggers something before the AI fully recognizes it quantitatively.
Precisely. That insight triggers an AI adjustment, prompts the AI to reweight its strategy layer based on detected calming volatility and poor signal performance. Tells the AI, hey, this isn't working, market changed, here's context.
And then practically with the portfolio.
System performs dynamic allocation. It reduces vol-sensitive positions, shifts toward mean reverting or carry signals, better suited for calm markets. Crucially, it flags all changes for human review, ensures transparency, oversight. Result: interpretive adaptability without overfitting. Learns and adapts with human guidance.
Incredible. Key design principles for building this symbiotic loop, this advanced AlphaQ intelligence.
First, complementarity. Humans set boundaries. AI optimizes within them. Second, metacognition. Systems monitor their own confidence, report when unsure, alerting humans. Third, causal enrichment. Humans input thematic insights. AI sector likely to lead due to geopolitics. Qualitative reasoning.
And transparent override. Critical safety net.
Absolutely. AI flags opportunities, humans control final deployment, partnership, not autonomy. And finally, interactive visualization, clear charts, tools like SAP Lime to make AI decisions interpretable, peeking inside the box.
So core takeaway, the future is not AI versus humans. It's AI with humans, an intelligent partnership grounded in feedback, transparency, mutual strengths. The ultimate AlphaQ intelligence for complex markets.
Absolutely. Creating resilient systems that learn and evolve alongside the market, leveraging the best of both worlds.
And that wraps up our deep dive into this fascinating, ever-evolving future of financial intelligence. We started with the messy reality of stock data, identified the diverse forces moving prices, fundamentals, emotion, even price itself. Then dissected limitations of older models and even first-gen AI.
And we rounded it out by delving into AI in finance, ultimately emphasizing the real power isn't AI alone, but its ability to adapt, understand the regime, and critically partner with human expertise.
The biggest takeaway, the core message we hope you carry with you. In dynamic markets, perfect prediction is elusive, a chase leading to disappointment. The real power, the cutting edge of alpha Q intelligence, lies in adaptive understanding and the symbiotic partnership between human insight and sophisticated AI, constantly learning and adjusting.
So, as you look at the market news tomorrow or hear another confident prediction, maybe ask yourself, is the model analyzing this adapting to the current market regime? And how much of its intelligence is truly symbiotic, that blend of human and machine?
What does this mean for the future of your own financial decisions and how you approach understanding this wild, beautiful, unpredictable world of investment?
It's definitely a lot to ponder, isn't it?
Always is.
From all of us here at The Deep Dive, thank you for joining us on this fascinating journey. We hope you feel a little bit more well-informed and perhaps a lot more curious.